You're preparing for your life after work, thinking about retirement. You've got an extra dollar. Now, what do you do with it? You want to save it? You've already made that decision. What are you going to invest it in? Stocks, exchange-traded funds, mutual funds, bonds, CDs, put it in a bank. So many choices. But how do you know which order to put money in? Should it be in a cash account? Should it be in an investment account? Should it be in a regular IRA, your 401k, or a Roth IRA? Hey, we're going to talk about it on Consider This Program today. Good morning and welcome to Consider This Program. I'm your host, Joe Clark.
I'm Dean Huddleston.
Hey, Dean is our senior advisor up in the Lafayette, Indiana office. Dean, happy to have you along. I have no idea, frankly, how many years you've been in the banking and financial services world, but it's up there with mine. It's multiple decades.
38.
That's a long.
I'm hitting now.
That is a long time. So when we talk to people about how to make the most of your working years, Dean and I are still going at it. We also help people, obviously professionally, figure out how to get the most out of it. And what we're going to talk about today is the order of funding your retirement accounts. In other words, you've got money that you have the ability to save. You've made the choice. You've made the decision. You're going to put it back for your future. Now, where do you put it? Dean, you're up.
So with the advent of pensions going away over the last few decades, really, people have been forced to become their own fiduciaries basically through 401k plans or 403b plans.
Now, what's a fiduciary mean?
Fiduciary. That means you have to take care of your money. So if we're your fiduciary, we have to take care of your money like it was our money if we were in your same situation.
But doesn't everybody have to take care of their own money?
No.
No. Why is that?
Most people, when they're in a 401k plan, as an example, they're making their own investment decisions. They are their own fiduciary at that point in time.
And this is a very important distinction that Dean is making. So when you look at the financial services industry, about 90% across the nation live in a world of suitability. So it could be somebody at a brokerage office that's saying, here's a great mutual fund for you to buy, or here's an annuity you ought to consider, or here's some investment. 401k is no different. Right? When somebody brings a 401k plan to you, and this gets to be very, very confusing for people sometimes. When somebody brings a 401k plan to you, the fiduciary exists inside of each mutual fund inside of your 401k, but only to that particular unit, not to you. They don't pick up the phone and call you and say, Dean, I think you should have 22% in this asset class and 18% in this. And oh, by the way, based on current tax code changes, you should move some of that money around. In the suitability side, they're not allowed to do that. And when you're functioning as your own fiduciary, that's your job. That's your objective. In Dean's case, my case, that's what we do professionally, where we make that decision for you based on your goals and objectives. All right, back to you.
So when we're talking about order of funding, one of the things that works in our world today is a lot of people work within a business that has a 401k plan or some kind of defined contribution plan. Difference, contribution plan versus a defined benefit plan, which would have been a pension from the old days. Most companies today still offer some kind of a match based on the amount of money that you are willing to put into your fund, into your account yourself. That money is what we like to call free money. You like free money, Joe?
Free money, good money.
Free money is good money. So anytime you have the opportunity and the ability to save funds for your retirement, if you have a plan like that available, that is probably your first source to go to. At least make sure that you are putting enough money in to get the total match. Some companies will match you up to 3% dollar for dollar. Some will even go as high as 6 or 7, or I've seen a few at 10 or 12. That is a fabulous amount of money that you cannot pass up.
So we're looking at this. So I've got a job. I work at the Financial Enhancement Group. I'm technically a managing partner, but I'm also an employee.
Yep.
I do have to fund my own match, which I find interesting. But that's always an accountant conversation that we have. And anyhow, so at the Financial Enhancement Group, we put in 3%, whether you put in 3% or not.
Yep. Safe harbor plan.
That does not happen very often. Most of the time, you've got to put money in to get the match. So let's pretend like it's a normal company. right? And what you're going to hear is a conversation where they match 50 cents on a dollar up to a certain percentage. Some places are dollar for dollar. You don't see that a lot anymore. But they may say something like, we'll give you 50 cents on the dollar up to the first 6%.
Yep.
Right? So what does that mean, Dean?
It means that you have to be able to achieve that full percentage they're going to give you. You have to get up to 6%. So you're going to get 3% of their money if you put in that 6. But you have to make sure that you're not just saying, hey, I'm going to throw $50 at this. You need to really look at the amount of funds that you're putting in, because that money is something that is going to go away if you're not funding it.
So I put in 6% to get the extra 3. So now I'm at 9%.
Yes, sir.
What do I do with my next dollar?
The next dollar, you've reached that max. So you've earned your free money. Taking it out, potentially you could fund an outside account as well, either a traditional IRA, or you could fund a Roth IRA.
Or you could put it in an account that's already after tax.
After tax.
Right. So one of the things that Dean is going to teach you when you come in for your Next Steps meeting, one of the things that you will hear is him talk about tax diversification. And that means when you go to separate from work, what you're really looking for are 3 baskets of money. Buckets, baskets, call them what you want. You're going to have some money that is tax deferred. So the money that your employer puts in for you in your 401k has to be tax deferred, right? The second thing you're going to have is tax-free money. Hopefully you figured out how to contribute to a Roth of some nature. Mm-hmm. Honestly, in today's world, the only people who shouldn't or who don't have a Roth or shouldn't have a Roth IRA are people whose income is too high to be able to contribute to a Roth, and their employer doesn't offer a Roth 401k option, and they don't have an IRA. If you don't have an IRA, traditional IRA, you're still eligible for the backdoor Roth IRA, at least in 2021, where there's still some things that are sitting there on the tax code. But yep. Dean, I'm back to you here with this question. I've got this extra dollar. Tell me specifically what I should be thinking about in terms of where that next dollar goes.
The next dollar's got to go to your best effort as far as that investment account. If you put that dollar in a savings account or a CD, you're not keeping up with inflation. So if it's an after-tax dollar, you get it into an investment account where you can beat inflation, get some real return for your dollar.
Yeah, but I've got that. It is a dollar. Now I can choose what I want to do with that dollar. What are my options?
You can put it in the 401k.
Right. So you, even though I'm up to the match, mm-hmm. I can still put more in the 401k.
You absolutely can. If you're 49 and younger, you can fund your 401k this year up to $19,500. If you're 50 and over, there's a catch-up contribution of $6,500. So you can put a tremendous amount of money, $26,000, within a 401k plan. And if you said earlier, if you have that option as far as a Roth, your contribution, all of it or part of it, can go into an after-tax account as well.
So you put, when I put money into the 401k, I make an option, I make an election, right? The amount of money that my employer put in had to be tax deferred. The amount of money that I put in, I can choose part of it or all of it to be Roth, since we have that as an option and a plan in our program.
Correct.
Right?
Yep.
Or I can decide that I'm going to put it in our trust account that's after tax, that's just out there, it's available. So we're building tax diversification. From the investment perspective of whether you use CDs or stocks or bonds, matters. Do not think that it doesn't matter. Inflation is a serious leak inside of financial planning. But in this case, it's really where that dollar goes. So what would you look at inside of my 401k to decide whether I should put money in the 401k or if I should put money in an IRA?
Well, I'm going to ask you one thing. We're going to look at your tax return, because if you're a high income earner right now and you're paying 22 or 24% taxes out of your paycheck right now, it may be better for you to defer some of that for a period of time, as opposed to paying that high of rate now, if you have the potential of lowering yourself in a bracket at some point.
So what he just said in English, and it's again, this is part of us doing this as long as it has. We do not know what the future tax rates are going to be, nope. Right? We know based on our income today where our marginable rate is and where our effective tax rate is. We know those two things. When we fast forward, remember your job when you separate from the workforce, or our job if you employ the Financial Enhancement Group or another fiduciary to help you, our job is not to replace your income, it's to replace your standard of living. Right? And you just have to think about that. So one of the things Dean and the team will sit down with you is to try to help you determine what that future standard of living is going to look like, so that he has an idea of what your tax rate is going to be, and that will give you a better guidance of whether you want to defer taxes or whether you want to pay taxes today.
Absolutely. Joe, we have a great resource at yourlifeafterwork.com, a number of articles that you can research and look at our website and determine whether your tax position is something that you really need to come in and see us about. Because people, we talk about financial regrets. We talk about making decisions today that will impact tomorrow. And if you're not making those kind of decisions, you need to see a financial professional.
It is our job to help reduce financial regrets. That's really what we do. Use the checklist, folks. They're free. They're a clear resource, yourlifeafterwork.com. You can give us a call at 800-928-4001 if there's something you need to know that's not on there. But don't forget to call, ask for Brittany, get signed up for your Next Steps meeting. We'll give you 90 minutes of our best thought that will help you today and in the future, and give you a road track to go on.